Welcome to the Get Know Trading channel. I am happy to see you here, where you will learn more about trading. If you like video, click the like button and subscribe. Do you know which names traders use for the Forex market? Maybe you have heard someone say FX, Forex or foreign exchange. It could be that you have heard all of them, because those are the names used among Forex traders for Forex market. Let me explain why they are using those names. Forex comes from foreign currency exchange. When you take first 3 letters and first 2 letters from foreign exchange, you will get Forex. Foreign exchange is a bit too long. It is a lot easier to say Forex instead foreign exchange. If Forex is too long, you can make it shorter. You can use first letter and last letter from Forex and you'll get FX. FX is the easiest to say, so Forex traders use it a lot. If you ask yourself which name to use, then you should know that Forex and FX are mostly used. Trading in Forex means investing money and using your skills to predict where the price of a currency pair will move. What means predicting where the price will move? And what means the price of a currency pair? Let's take an example, so you can understand it more easily. I will use euro and dollar because they are well known. They are 2 most used currencies in the world. If you take euro and US dollar and put them together, they will have a certain price. This combination of currencies is called currency pair, and their price is called pair price. You see that you have euro on the first place and US dollar on the second place. First currency in a pair is called base currency and second currency is called quote currency. If this combination looks strange, maybe it is easier for you to understand if I make this a little bit different. This pair combination can be written like this, which is the same. Now you have a price of 1 euro is equal to 1.1833 US dollars. You can see I have shortened the name of euro and US dollar. There is a convention that defines what is a short word for certain currency. British pound have GBP, US dollar have USD, and so on. Here is a list of most known currency pairs, so you can get familiar with them because you will use them a lot. Now let's get back to the trading. I said you need to have a skill to predict where the price of a currency pair will move. Predicting means a decision, will the currency price move up or down? That means if you look at the example Euro USD equals 1.1833, the question is, will the price of a pair rise in value, meaning going up, or it will lose its value, meaning going down? If you know that the euro will fall in value against US dollar, you'll invest your money and predict the price of Euro USD will fall down. To show you how this will look on the real trading example, here is a trading chart with the Euro USD currency pair. The chart shows how does the trading platform looks like when you start trading on the Forex market. In the upper left corner you can see the currency pair you have on the chart. You have a currency pair price on the right side, which shows Euro USD equals 1.18339. As the time passes, the price is moving up and down and up. Your job as a trader is to predict where the price will go in the future. If you want to make money by trading, you need to know how to predict where the price of a currency pair will move from the current price. This is what trading is all about. It is knowing how to predict where the price of a currency pair will move. You will make money if you predict correct direction. If you predict wrong, you will lose money. Now it is time to show you what means when the price change. In this example, you see that the current price is 1.18339. So the price can change up or down. And that means Euro USD can have price higher than 1.18339 and lower than 1.18339. Let's take the current price and put it here on the left side. And let's say the price goes up to the value of 1.18349. And in a second case, the price goes more up to the 1.18359. You see that there are 5 decimal places in a price, and the change was on the 4th decimal place. Fourth decimal place represents the pip, and the pip is the change in a price. In our case, we have a price change from 1.18339 to 1.18349, and that change is a change by 0.00010, which is equal to 1 pip. In a second example, where the price changed from 1.18339 to 1.18359, the change is by 0.00020, which is equal to 2 pips. You see, the change on the fourth decimal place by 1 represents the change by 1 pip. If the change is higher, then the change will be by more pips. Now let's see when the price falls down from 1.18339 to 1.18329 and 1.18319. When the price falls down from 1.18339 to 1.18329, the change is by 0.00010, which is again equal to change by 1 pip, because the change is on the fourth decimal place. In case of price change from 1.18339 to 1.18319, the change is by 0.00020, which means change by 2 pips. And that is all about the price change, which has the price change on the fourth decimal place, and it is called the pip. If the price changes by more than 1 pip, you will have change by more pips. The change can be by 10 or more pips. What is important to know is that you have a fifth decimal place, and that fifth decimal number is 10 times smaller than a pip. In our example, when the price increases from 1.18339 to 1.18349 and 359, we have change by 0.00010 and 0.00020, which is equal to 1 and 2 pips. But at the fifth decimal place, we have number 9, which represents the pipette. The pipette is 10 times smaller than a pip, so when you have price change by 1 pip, that means you have price change by 10 pipettes. In our case, we have price change by 10 and 20 pipettes. When the price falls down from 1.18339 to 1.18329 and 319, we have change by 1 and 2 pips, which means change by 10 and 20 pipettes. Here's an example when the price changed the value by more than 1 or 2 pips. This is an example just to show you how it looks like in a trading platform you will use in trading. You need to understand what is a pip and pipette, because later you will need to calculate how much you will make money or lose when trading. Let's say the price goes up from the current price. Current price is 1.18875. When you calculate the difference from the previous price to a current price, you get 1.18875 minus 1.18339. which is equal to 0.00536. Now you have change in the third decimal place, and on the fourth and on the fifth decimal place. The change on the fourth decimal place is change in pips, which in our case means the price changes by 3 pips. But the price change on the third place represents 10 times pip change, which in our case means the price changed by 50 pips, because we have 536 at the end. And on the fifth place we have change by 6, which means 6 pipette. We can say the price changed by 53 pips. We can say the price changed by 53 pips and 6 pipettes, or 53.6 pips. Let's say the price falls down from the current price to 1.18600. And the price difference compared to starting price 1.18339 is 1.18600 minus 1.18339 is equal to 0.00261. Like in the previous example, we have price change on the third, fourth and fifth decimal place, which means the price changed by 26 pips and 1 pipette, or 26.1 pips. You see, it is not a problem to see how much pips the price changed. This is important to understand for the following lessons, because you need to know how to calculate what is the value of each pip you make or lose by trading. So if you use 26.1 pips, you need to know how much money that will be. If you predict the price will fall down and the price falls down by 26.1 pips, you need to know how much money will that be. To learn how much 26.1 pips is equal in US dollars, you need to learn what is a lot size. A lot size or volume in Forex represents how much one pip will be equal to. By selecting correct lot size, you can decide that one pip will be equal to $0.10, $1, $10 or more. You can see on the image how that looks like in the MT4 platform. You select volume in the drop-down window, or just type in the box value how much you would like to use in that trade. You see that in the drop-down window you have values from 0.01 to 8. The values you do not see here, like 0.10, you can simply type in the box and that will be enough. To simplify lot size or volume, you need to know that there are few lot sizes that are usually used in trading. First one is called standard lot size, which defines a lot with 100,000 units of base currency. Earlier I said that the base currency is the first currency in a currency pair. In the image before, you have seen the drop-down menu with lot sizes, and there was a lot size equal to 1.00. That represents one standard lot. The last number you have seen is 8, which represents 8 standard lots. 10 times smaller lot size than one standard lot is called one mini lot, and it represents 10,000 units of base currency. In the drop-down menu it was not shown, but if you want to use one mini lot size, you need to type 0.10 in the lot size or volume box. Here are a few examples of mini lot size so you understand what it means when you select different lot sizes in MT4. And the third most used lot size is called micro lot size. Micro lot size is 10 times smaller than a mini lot size, and it represents thousands units of a base currency. In the drop-down menu for lot size or volume in MT4, it is located under number 0.01, which means one micro lot size. Here are a few examples of micro lot size, so you understand what it means when you select different lot sizes in the MT4. As a beginner, you wonder which lot size to use. What would be the best lot size, so you do not pick the wrong one. Here is a table with pip value of each lot size you select. You can see that the value of 1 pip for a standard lot size, which is selected in MT4 by selecting 1 in the drop-down menu, is equal to $10. And that means for each pip you make or lose by trading, you will have $10 in profit or in loss. Each pip is valued by $10. If you use mini lot size, which is equal to 0.10, the pip value is equal to $1. And the micro lot size will have $0.10 per each pip. So for the smaller accounts that have $10 up to $100 for trading, the best would be to use micro lot size. And the reason is, if you open the order with 0.01 lot size, each pip that moves in your favor or against you is valued by $0.10. 1 pip is equal to $0.10 is only valid if your account have USD as a currency and you are trading the pair where USD is on the second place, or as it is called, quote currency. For example, Euro-USD pair. If the trade goes against you for 10 pips, you will lose $1, and that is because 10 pips multiplied with $0.10 equals $1. You can open many trades without worry that the account balance will be wiped out very quickly. If you are practicing on a real account, micro lot size is the best because you will not lose too much if your trade is losing one. Many beginners start with small amount of money and micro lot size. In the case at the beginning, you had the price change by 26.1 pips, so you need to calculate the value of that price change. If you predict correctly and the price changes in your way, that means you make money. With 26.1 pips in your pocket, and if you use one standard lot size, you can make $10 multiplied with 26.1 pips equals $261, which is great. But if the price goes against you by 26.1 pips, and if you use one standard lot size, you can lose $261. That is not a good to see, because on a small trading account with $500 account balance, that means losing half of your invested amount. And to have some kind of protection, not to lose all your money at once, you can decide to use a smaller lot size, so each pip will not be equal to $10. You can decide to use micro lot size, which is equal to 0.01, where one pip will be equal to $0.10. Then you would make 2.61 or lose $2.61. One thing you need to know is that if you want to use a standard lot size, where one pip is equal to $10, and that means trading 100,000 units of base currency, you need to have $100,000 on your account. For majority of us, it is not easy to invest $100,000, so the broker offers you leverage. With your $1,000, he can give you option to control $100,000. And that is just by giving you leverage 1 to 100, where your $1,000 is equal to $100,000. When selecting the leverage, at the start, when you open your trading account, you define how much money you will control. That means if you invest your $1,000 and selecting 1 to 100 leverage, you define that you will control $100,000. $100,000 means you can control somewhere near one standard lot size, which is 1.00. That can mean that each pip can be equal to $10. The broker gives you opportunity to make more by each trade you open. Selecting 1 to 500 leverage, you define that you will control $500,000. $500,000 means you can control somewhere near 5.00 lot size, which is 5 standard lots. That can mean that each pip can be equal to $50. But have in mind that leverage, as it looks good to control more money, means that you can lose a lot. It is a double-edged sword, because you can quickly make a lot of money, but also to lose quickly all what you have. Why everyone tells you that the leverage is double-edged sword? It is because leverage works both ways. When you make money, when you predict correct market direction, each pip gives you profit. That profit can be $1, $10 or even $100 per pip. When you lose money, when you make wrong prediction about the market direction and each pip gives you loss, that loss can be $1, $10 or even $100 per pip. By the example above, you see that the leverage works in both ways. That's why it's important to select the correct leverage so you do not lose a lot when the market moves in wrong direction. This was enough about pip value, lot size and leverage. Now it is time to show you what is margin. It is something you see in the MT4 platform when you open a trade. The margin is not so crucial for trading, so at the beginning you will not pay attention too much to margin. But I want to show you what it is and how it works, because you never know when you're gonna need this. If this is too much for you now, you can simply skip this part about margin, free margin and margin level. Margin is the amount broker uses as a collateral for leveraging. Broker uses the margin to put your orders on the interbank market. Margin is used only on leverage account and is left on your account after all orders are closed. Here is the usual margin requirement. Here is an example how this looks like in MT4 when you open an order. I have opened GBP/USD order at the price of 1.31170 and the margin is equal to 131.17. How this is calculated, it is shown here. This is the formula how to calculate the margin amount. It is a simple formula where you use base currency, account currency, where in my case this is US dollar, and multiplied it with units, and units represents a lot size you will use. In my case I am using a mini lot size, which is 10,000 units of base currency. And when I calculate all that, I need to divide that with leverage I am using. I am using 1 to 100 leverage, so the result for margin is 131.17. The broker has took 131.17 US dollar on the side for the trade I have open. And this money I cannot use for trading, so if the trade goes against me and I start to lose money, I cannot lose margin amount that is set aside. That amount is not available for trading. Here is an example how this looks when I use two trades open at the same time. First margin is equal to 131.17 and second margin is equal to 131.14. Total margin is 262.31 US dollar. And that is what you see in the MT4 when two orders are open. On the third example, I want to show you how margin looks when the trades are positive. I have left two trades open until they become profitable one. And when that happens, the margin stays all the time the same. Two trades are positive and my account balance will increase if I close these two orders. If I close two orders at this moment, I will make $5.10, which will be added to my account balance. What is changing here, how the profit changed, is the free margin value, which is right next to margin. What is good to remember, the free margin is the rest of the money you have left to spend on other trades when one or more trades are open. If you do not have a free margin left, you cannot open more trades. When you close some currently open trades, you will free some margin and free margin will rise. When the free margin is completely used and if the trade goes in negative, you will get margin call. In the example you see that the free margin depends on the equity and margin. Margin stays fixed on each trade, so the only one that is changing is the equity. How the equity changes, and that is by the profit on each trade you have, that is how the free margin changes. Here is calculation of a free margin for this example. Free margin is equal to equity minus margin on open positions. In my case, that is 995.80 minus 131.17, which gives me free margin equal to 864.63. In the example with two trades open, margin amount stays the same, and that is 262.31 US dollar. If I want to open more orders, I can do that all the time when the free margin is available. Here are a few facts you need to remember about free margin. I can open more orders until the free margin is available. Free margin is reducing when a new order is open, and if the trades are losing one. Free margin will rise in value if the trades that are open are rising in value. In the example here, you can see how free margin reduces when trades are losing one. I have orders that together are in minus by 5.90 US dollar. If the trades are at zero, meaning there is no loss or profit, the free margin will be equal to equity, that would be 1000. 1000 minus margin that is set aside, and that would be 737.69. But I have two orders open that together gives me minus 5.9, where free margin is equal to equity minus margin, and that is 994.10 minus 262.31 gives me 731.79, which you can see in the image under free margin. In the third example, I have two orders that are positive, and you can see how free margin increases, because equity is increasing. Margin value, which is 262.31, stays all the time the same, but the equity is increasing and free margin is increasing. If you take a look on the previous slide, I had free margin 731.79. You see that my positive trades have increased the free margin, and immediately I have more space for current orders or if I want for new orders. You need to remember that the free margin is floating value and it can rise or fall depending on the current status of open orders. And the third margin you see is the margin level. That is the level shown in percentage. Margin level in Forex tells the trader how much of their funds are available for new trades. Margin level should never fall down close to 100%, because you will get margin call very soon after that. It is calculated like margin level is equal to equity divided with margin and multiplied with 100 to get in percentage. Margin level depends on leverage, lot size used on the open orders. Lot size affects margin, that is part of the formula for margin level. Here are a few examples. In the first example, I have one order open, where the equity is 995.80 and the margin is 131.17. When the calculation is done, I get margin level equal to 759.17. In the second example, I have two orders open and the free margin, when calculated, is equal to 378.98%. Margin level depends on the amount of open orders through margin. If you have more open orders, margin will be higher and consequently the margin level will decrease. The result of the open orders impacts on the equity and consequently on the margin level. Do not allow that margin level falls down close to 100%. Reduce the amount of open orders or reduce the margin, or increase the equity through investing more money on your account or have positive trades. Two orders are open to show you when the trades are positive in total. The balance is positive and the equity is larger than balance. This means my margin level is larger and I have more money to open new orders if I want. Margin level is equal to equity divided with margin multiplied with 100, and that is equal 383.55%. If you take a look on the previous slide, I had margin level 378.98%. You see that my positive trades have increased the margin level and immediately I have more space for current orders or if I want for new orders. This is all about margin you need to know. It is explained with few formulas, but you do not need to bother with them, because it is all automatically calculated for you. The only thing you need to pay attention to is to have profitable trades. If the trades are not profitable, you will be warned by the MT4 platform when you need to know that your balance is in danger. If there are some issues with margin levels, you can expect to have problem with opening new trades. If that happens, you can come back here and calculate margin levels and see what could be causing the problem with opening new orders. Now it is time to explain you what are two prices you see on the chart, because you have one price for selling and one price for buying. So when you decide the price will move up, you open buy order, and when you decide the price will move down, you open a sell order, but on a different price. Two prices you see on the chart are bid and ask price. Bid and ask price in Forex market are two prices you see on the chart in the trading platform. Bid and ask price represents the price you will enter into the trade when you open buy or sell order. When you open a buy order, you will pay the ask price, which is higher than bid price. And when you want to open a sell order, you will pay the bid price, which is lower than ask price. What is important is that you need to understand that you as a trader buy or sell currency pair from the market maker or a broker who's acting as a market maker. So when you see bid and ask price, you need to understand, is the bid price for you or is it for the market maker? And is the ask price for you or it is for the market maker? Below you have an image where you can see that when you buy at ask price, at the same time that means market maker is selling to you. And when you sell at bid price, at the same time that means the market maker is buying from you. You always end up with a bad price, which is the cost you pay. This will be explained further in this lesson. The bid price is calculated by subtracting the ask price with spread. That means bid price is equal ask price minus spread. In case where the ask price is 1.12716 and spread is 0.9 pips, then the bid price will be bid price equals to 1.12716 minus 9 pipettes, and bid price is equal to 1.12707. Here is an example with the bid price. For example, let's say you want to buy a Euro-USD pair where the ask price is 1.12716 and bid price is 1.12707. The price you will pay will be the ask price because someone on the market is ready to sell you that pair for that price. At the start, you will be in minus for the spread, which is the difference between bid and ask price. So you need to wait until the bid price, which is 1.12707, reaches your entry price, which was the ask price at 1.12716. When that happens, you will be at zero, no profit and no loss. If the price continues to move up, you will make money. But what or who will move the price up so you make money? Let's say your friend comes to the market and wants to buy the EUR/USD pair. There is someone who is willing to sell EUR/USD pair at 1.12717. So your friend buys the EUR/USD pair and the price of EUR/USD increases. Now you have bid price at 1.12716 and ask price is 1.12725. If you sell now, you will make no money because the bid price is at the price which is equal to you being at zero, no loss. But if you wait for some time and more buyers come to the market and they push the price higher, you can exit from the trade with profit. So it all depends on the supply and demand on the market. Let me explain what does ask price means. Ask price means what is the price someone is willing to sell the currency pair to you. And that means the price you want to buy the currency pair at. If the broker is a market maker, he will offer you the ask price he is willing to sell you the currency pair. The ask price is calculated by adding the spread to the bid price, and that is equal ask price is equal to bid price plus spread. In case where the bid price is 1.12707 and the spread is 0.9 pips, then the ask price will be ask price is equal 1.12707 plus 9 pipettes, which gives you at the end 1.12716. Here is an example with ask price. For example, let's say you want to sell EUR/USD pair where bid price is 1.12707 and ask price is 1.12716. The price you will pay will be the bid price, because someone on the market is ready to buy from you that pair for that price. At the start, you will be in minus for the spread, which is the difference between bid and ask price. So you need to wait until the ask price, which is 1.12716, reaches your entry price, which was at the bid price at 1.12707. When that happens, you will be at zero, no profit and no loss. If the price continues to move down, you will make money. But what or who will move the price down so you make money? Let's see again the same example with your friend. Let's say your friend comes to the market and wants to sell the EUR/USD pair. There is someone who is willing to buy the EUR/USD pair at 1.12707. So your friend sells the EUR/USD pair and the price of EUR/USD declines. Now you have an ask price at 1.12707 and bid price at 1.12698. If you buy now, you will make no money because the ask price is at the price which is equal to you being at zero, no loss. But if you wait for some time and more sellers come to the market and they push the price lower, you can exit from the trade with profit. So it all depends on the supply and demand on the market. Let me explain what is the difference between a bid price and ask price. Simply said, the difference between bid and ask price is spread. It is the cost you pay to the market maker or a broker. The difference between bid and ask price is fluctuating all the time, so the spread can vary. But in some cases, a broker offers you a fixed spread, where the difference between bid and ask price stays all the time the same. Usually there is a variable spread, which depends on the market conditions. If the market experiences news related to the currency, that will have an impact on the spread. The difference between bid and ask price will increase, which will make the trading more expensive. If that happens, you should wait until the price returns back to normal, the difference between bid and ask returns to acceptable value. So who benefits from the bid-ask spread? The only one who has benefited from the bid-ask spread is the market maker. That means the broker you are trading with. If the spread is wider, the broker will make more money on each trade you open. So they are trying to widen the spread as much as possible. But they need to be careful, because if the spread is too large, then the traders will avoid trading that currency pair, because the cost of the spread is too expensive. Below is an image with high spread, which makes the pair expensive for trading. The broker tends to lower the spread as much as possible to attract more traders who are willing to trade, and with more traders, they will make more money. More trading at the end will cover small spreads where they make more money. Here is an example how they make money. Usual spread is around 1 pip on Euro USD. If you open one standard lot, which means 1 pip equals to $10, the broker will make $10 per each trade. One standard lot is equal to $10 per pip. If you open 10 trades per day, the broker will make $10 per each trade. So this gives us 10 pips multiplied with $10 equals $100. The broker makes $100 from you just allowing you to open a trade. If you increase the spread to 2 pips, then the broker will make 2 times more. And that is $200 on 10 trades you open. Your job is to find a broker that has an acceptable spread cost, and that means less than 1 pip, which will make trading less expensive. If you like this video, click the like button and subscribe. Now it's time to show you on the trading chart inside trading platform all what I have said up to now with demo account. That way I want to show you with real example. That way you'll be ready for trading with basic knowledge about forex trading. But you first need to have a trading platform on your PC. Now I will show you how to download MT4 platform and how to open demo account. After that you will prepare charts for trading. First, let's download MT4 platform. In the description of this video, check the link for MT4 download. Please click on it and the download will start. The file you download you need to save on your PC. Find the file you have saved and right-click on the file and select to extract the file. When you do that, you need to start MT4 application, and that is done by starting the terminal file. When you click on the terminal file, MT4 platform will start and a new window will appear. The small window at the start is asking you to select the broker you will use. In this case you do not need any broker, so we will use free option, and that is MetaQuotes server. In the search field, please enter MetaQuotes and click Scan. The MT4 platform will find MetaQuotes demo server and you need to select that server. Click on the MetaQuotes server and click on the Next button. Next step is to select which trading account you will use. You will use demo account for practicing, so please select New Demo Account and click Next. In this step you will need to open demo account. It is a simple process and it takes less than a minute. You need to enter account details. You can enter your personal details here, or you can type anything just to fulfill the form so you can move to the next step. But here are a few empty fields you need to enter with correct data, and those are deposit amount and leverage. Deposit balance is the amount you will have for trading. You see $100,000, which you will use for trading. I will change this to $10,000. Leverage is set 1 to 100 and you can leave that as it is. Later on, if you decide to open demo account with different values, you can change this data and have what you want for trading. When you fill all the data, click on the checkbox so you can continue further. When you click on the next button, you will open new demo account. Here are the data about the demo account you have open. Click on the finish button. The MT4 platform will start with the demo account open. Demo account will be on the left side and below you will see a message. When you open that message, inside you will have account details. This message will stay here so you can read it again later on if you need. When you click on the Trade tab below, you will see your account balance. I have $10,000. That is the amount I have defined in the process of opening a demo account. If you have selected different account balance, you will have here different amount. In the middle, you have black window. So I will select currency pair in the left window where all currency pairs are located. Just select EUR/USD currency pair and drag and drop it on the blank window. You will get a window with green line on it. I will prepare the chart for trading by changing the colors of the chart. To do that, I will right-click on the chart and select Properties. In the new window, I will select black and white combination in the color scheme drop-down menu. Now I will change two more settings, and those are Ask Line and Grid. In the Common tab, go to Show Ask Line setting and click on it. This will activate Ask Line on the chart. And then uncheck the Grid option. I do not want to have Grid option on the chart because I want to have a clean chart. When you finish, click the OK button, and the chart will change color. I will change chart type and select Candlestick chart, and I will maximize candlesticks so it is more clear to watch. And this is all. You have trading platform with the demo account open and with a clean chart ready for trading. First, what I'm gonna do is to open a new order. To do that, you need to click on the upper button for a new order. New window will appear where you need to enter some of the details for that order. What you can see here, you see the tick chart on the left. On the right side, going from above, you have currency pair. In this case, it is Euro-USD, because I have chart with a Euro-USD pair on it. Then you have volume box, where you need to enter value. In the part about lot size, I have said that the volume is same as lot size. So you need to enter here a value from 0.01 up to some desired value. With this value you define how much one pip will be equal. If you have forgot, then here is a quick reminder. Standard lot size, which is 1.00, gives a value of $10 per 1 pip. Mini lot size, which is equal 0.1, gives a value of $1 per 1 pip. And micro lot size, which is 0.01, gives value of $0.1 per 1 pip. I will leave 1, which means 1 standard lot, and 1 pip will be equal to $10. Below volume, you have Type drop-down menu. In my case, it is set to instant execution, which means I will open order at the current price. The current price is visible in the part below, where you see two buttons, red and blue. I will open an order and I will press a blue button where it says Buy. That means I think the price will go up from the current price. When I click on the button, I get a message that a new order is open, with volume 1, and the price 1.15672. I will click on OK button, and below you can see that there is a new row with a new order. On the right side of that row, you have current status of the order. I am in minus $21. I will change the value in the order row to show me the pip amount, and below that I will have what is the current profit in US dollars. Now what you see is the number of pips. I have 23, which means 2.3 pips. In the left side of this row you have account balance. I have $10,000 on my account, which I have defined when opening a demo account. Then you have equity. That is the number that is changing all the time as the price of a pair changes. If the equity is lower than the balance, that means the order that is open is in minus. In my case, I am in minus for $24, so the equity is $10,000 minus $24, which is equal to $9976. I will change the time frame to 5 minutes, so I can show you the current price on the chart with bid and ask price. You see, you have two lines, one is red and one is gray. Those two prices are ask and bid price. Ask is red line and bid is gray line. The difference between them is the spread. The current difference between them is 1.15664 minus 1.15643, and that is equal to 2.1 pips. I have opened buy order, so that means I got the bid price. And the difference between the price I have opened the order and the current bid price is 2.8 pips. Now it is 2.9 pips. You see, the price is changing all the time, so the current profit or number of pips is changing all the time. But I have 2.9 pips now as a difference. 2.9 pips difference I got by subtracting the current bid price from the price I have opened the order. I have opened the order at 1.15672 and the current bid price is 1.15643. When I find the difference between them, and that is 1.15672 minus 1.15643, I get 0.00029, which is 2.9 pips. 2.9 pips with a volume equal to 1, which is standard lot size. I have $29 in minus, because each pip is equal to $10. I will now close this order, and that is done by double-clicking the row where the order is. A new window will show up. There is a yellow button where it says "Close the order at the current price." I will click on it and order will close. You see in the row where the balance is that my balance has changed and now is equal to $9967, which means I have lost $33 with this order. I have lost $33 because I have predicted the price will go up and I have opened buy order. But the price did not go up, but it moved down, and I have lost money. Now I will open new order, but I will now open sell order, because I think the price will move down, so I'm expecting to make some money. When a new order opens, I have again a new row, where the current status is visible. And at the start I am in minus $22, but the price did not move up or down. Do you know why? That is because of the spread. Spread, which is difference between bid and ask price, is the cost you pay to a broker for trading. The spread amount was now taken from my current balance, but the broker opened my order with loss of 2.2 pips, which is $22. So the broker has earned $22 on my order. But I am in minus at the start, and I need to wait until the price moves in my way. And that is down, just to be even. I need to wait for the price to move down 2.2 pips, just to be even. Now I will wait for some time to see where the price will move. And after some time the price moved down, so my loss has decreased. I am in minus for 4, then 3, then $2, and then $0. You can see on the left side my current equity. It's changing as the price changes, and I have returned back to the starting equity, which was $9967. Then the price changes in the opposite way compared to my prediction, so the equity decreases. Now you see how the trading works. You open an order and wait for the price to move. The best is if the price moves in your way. I will close this order so I can show you more examples. When I close the order with minus, that is visible on my current balance, which is now $9948. My last trade was negative with $19 of loss. I will now open new order, but I will change the volume, which means lot size. And that means the pip value will not be $10. You see in the drop-down menu, there are values to select. But I want to open mini lot size, which means volume is equal to 0.1. I do not have 0.1 in the drop-down menu, so I will simply type it and click on the buy order. Buy order because I think the price will move up from the current price. New order is visible in the below window as soon as I open new order. I am in minus $2, again in minus. And again, that is spread that represents the cost for trading this pair. But now I have minus $2 with 2 pips. You see, with smaller lot size or volume, the pip value, in my case 2 pips, is equal to $2. In the previous example I had minus around $20, and now I have 10 times smaller loss, because I have defined with lot size that I want to have each pip valued less. Now I will wait for a few seconds, just to show you how the profit changes with price change. Now I will close this order and then open a new order with smaller lot size. I want to show you again how the pip value changes with lot size. I will open new order with micro lot size, and that is equal to 0.01 in the drop-down menu. I will select this value and open buy order. When I open a new order, I have minus $0.2, which means 2 pips. And as the price changes, the current profit or loss is changing. But now you see that I have 10 times smaller loss than in the previous example. Micro lot size defines that 1 pip will be equal to $0.1, and with my 2 pips I have loss of $0.2. As the price changed, the profit changes. So you can see here values around $0.2, 0.15, 0.17, and so on. And that is all what I wanted to show you how trading is done. And how the lot size affects the pip value. With lot size you define how much you will make per each pip. So pay attention when selecting the lot size. Now I will show you what is margin and free margin. For this part I will open another demo account with $10,000. That way it will be easier for you to understand when I open order and how the margin and free margin changes. The process of opening new demo account is pretty quick. When new account is open, on the left side you will see that new account. I have $10,000 on my account and I will open a new order. I will open a new order with standard lot size, where 1 pip will be equal to $10. When I open new order, you see that I have margin equal to $1156.69. That is the amount the broker set aside, and I cannot use that amount for trading. Free margin is $8822.31, which is the rest of the money of $10,000 I can use for trading. That amount is calculated like this: 9979 as equity amount minus margin, which is 1156.69, I get 9979 minus 1156.69, and that is equal to 8822.31, and that is free margin. Now look, as the price changes, my profit changes. With profit change, the equity is changing, and as the equity changes, the free margin changes. If my profit increases, the equity and free margin increases. Now I will open another order, so I will have 2 orders open. When I open new order, you see that the margin is increased. Now margin is equal to $2313.34, and free margin is reduced. I have 2 orders open and both of them are in minus. I will wait until both orders become positive to show you how the equity and the free margin change. After some time, the price has gone in my direction and both orders are positive. I am in profit and equity is larger than balance, and that means if I close these orders, my balance will be equal to equity. Margin is the same and it does not change, but free margin increases as the equity increases. When you compare the free margin earlier when orders were in minus and now when orders are positive, you can see the difference. The free margin is the amount of money I can use to cover the loss on these orders, or I can open more orders. Until the free margin has some amount, which means it is positive, I am able to leave these trades open, even they are in loss. If my open trades lose more money, and I mean lose more than free margin now shows, I will get warning that I should close open orders, or invest more money to sustain loss on open orders. I will now close both orders. What you have seen in this lesson is that how to start trading on the Forex market, how trading looks like in trading platform, and what are the basics you need to know when trading. I hope you have enjoyed. If you have any question, feel free to leave a comment. See you in the next lesson and happy trading. Thank you for listening. If you like this video, click the like button and subscribe.